Hi, today's topic is forensic business valuations. What should be in and what should be out? There are many misconceptions in the marketplace as to the valuation of business and of the assets involved. So let's consider how to value all the assets of a business. The methodology that I recommend is one that values all the components of a business, separates them and itemises all findings in a full disclosure format based on market activity. It is this detailed format or concept of leaving no stone unturned that elevates business valuation reports to forensic or detailed status. It is most important that the viewer has the ability to understand that accounting and taxation concepts have nothing to do with market values. Markets move all the time, and accounting and taxation concepts have to do with the past, not the present. Most forensic business valuations do not satisfy the requirements of the definition or the legal industry. In fact, many forensic business valuations have been prepared by persons who have neither inspected the business, read the lease, or classified revenue streams. A high percentage put forward valuations to courts that are not based on market activity whatsoever, even though they claim so. I recommend that you view my video on business methodologies, which will outline the massive problems associated with the old methodologies used. All you have to do to prove the flawed nature of their report is to challenge where they got their multiplier from. This method of plucking a number out of the air based on guesswork or hearsay, and it is not based on any market numbers whatsoever, yet they claim in their report it is based on industry averages. What utter baloney. Then they have tried to build in a comfort zone by introducing two industry averages, which by itself is misleading. They then claim one is high and one is low, and they settle for something in between. But you can always shoot them down in courts if they are made to answer under oath. Therefore, it is my opinion that most so-called forensic business valuations should be thrown out as being inadequate. The method I propose is one based on provable figures, and the multiplier is obtained from market comparison, and it is simpler, faster and more reliable, and will satisfy the definition of a forensic report. One of the major differences in their report is that they do not separate tangible assets from intangible. They treat them the same. And they do not realise that tangible assets are ignored in their approach, and they cannot see that the new methodology is simply the inverse of what they do. In order to prepare a forensic report, all components must be examined, tabulated, researched and valued. And on the basis of the valuation, all of them must be stated in full. Not only should tangible assets be valued, but all fixed costs must be explained. The premises must be inspected, the passing rental must be compared to similar properties within a similar location and commented on in the report. This is rarely done, and if you don't believe me, view the reports on public record. Now, this brings us to the intangible assets valuation of a business, and this includes the overall intangible asset known as goodwill. But the business may also have IP assets that require valuation. I believe it is an offence to use any numbers out of a balance sheet because they are based on historic values, taxation concepts, and some assets, particularly cash at bank and vehicles, will not pass with the business. Intangible assets. Many have absolutely no clue on how to value the assets or asset classes of a business, including corporate Australia, And this confusion is promoted by accounting and taxation concepts. Firstly, ask them where they were trained on how to value intangible assets. They have never been taught in universities, nor can they agree on the attributes of intangible assets. And I refer you to AASB 1013. They simply rely on the cost approach and depreciation of assets called written down values and plant and equipment as contained in financial statements or depreciation schedules. Now, they are completely misleading for many reasons. They're not based on market activity. Full recording of all assets is not disclosed in depreciation schedules. Accelerated depreciation of asset classes treated differently, some expensed in the first year. Rapid write-offs for new vehicles and other specialty equipment. Acquired plant and equipment is never recorded at current market value. It's always written down value. Next, they do not know how to value the intangible assets because, as I've said, they have never been taught. They assume asset values are tied to net present value or discounted cash flow methodologies. They ignore market transactions. They invent, manufacture, guess, or rely on hearsay multiples that can never be proven. They combine both tangible and intangible asset classes in their deliberations. They use any methodology that is not based on market activity, such as relief from a royalty method. Now, to expound this, a case study, some time ago in Australia, a large public company purchased a private business for some $20 million based on the relief from royalty method. But the stupidity did not stop there. At the time of purchase, the tangible assets were worth $1 million. So in effect, $19 million was paid for goodwill. The net profit at the time was $100K. This means it would take 190 years to get your money back on a simplistic basis. There were no other buyers competing for this asset, which could have been purchased for $2 to $3 million. All the management personnel involved in this transaction should be sacked. They are responsible for deceiving, cheating, and shortchanging all shareholders who ultimately lost value. So who among you would pay $2,000 for an item that you can buy for $200? I believe your answer would be no. Yet this type of activity still happens on a regular basis. Generally, large amounts paid for IP assets are only paid by public companies because it is not their money. Private companies or individuals are rarely deceived because they spend their money wisely and employ the greater concepts and laws of markets such as knowledge, power, economic position, and lack of competition. Valuers should use numbers they can prove and are based on market transactions. You cannot invent value. It is either supported by market transactions or it is not. You cannot combine tangible assets with intangible, yet that is precisely what they do. If you do not know where the revenue comes from, you will never be able to value a business accurately. Let's consider the example on your screen. Both businesses have a turnover of $1 million. Both have EBITDAs of $500K. For the result would be $500,000K times by 3, their multiplier, equals 1.5. What utter rubbish. Business B is far superior in value to business A. Yet imagine all the so-called experts that they claim they can value a business on net profits, EBITs or EBITDAs. It is a monumental foolishness. Value is found in market exchange or turnover, not a manufactured figure. Remember, you will never receive someone else's net profit. All you are buying is the revenue streams if they are transferable. Now, items that should never appear in a forensic business valuation, and they are products of management or manipulation. They're called internal, and it's based on a micro view, and it is totally unprovable. Net profits. Misleading because they're generally minimised to reduce taxation. Add-backs. Vendors' discretionary income or expenses, what utter rubbish. EBITs are earnings before interest and tax, meaningless drivel. EBITDAs, earnings before interest, tax, depreciation and amortisation, bigger, meaningless drivel. Multiples used based on manufactured results, guesswork or hearsay, not market-backed. Weighted or WACC, weighted average cost of capital. Borrowings are a product of management, not markets. Written down values are based on taxation concepts and have absolutely nothing to do with current values or markets. Balance sheet valuations or net asset approach or equity values are distorted and misleading. And the all-in approach, the current values of tangible assets are ignored. Capitalisation of net profits is insane. Yet they ignore economic life scenarios and need risk rates to determine the interest rate. Risk rates must be inferred from other business sales within the market. In fact, if any of these exist within a report, throw it in the bin, unless used as comparison to higher methodologies. It means the report is based on someone's opinion, not market facts. Now, items that should appear in a forensic business valuation, and that is market-based valuations, and this is based on the macro view and totally provable. Turnover methodology based on completed sales in the marketplace. You can prove turnover. And it can also identify management issues and key performance indicators. The turnover can be profiled based on age, average sale, geographic location, income, gross profit, expenses. In fact, any business owner must know how to profile their turnover and benchmark to know where they sit within an industry. And of course, they can be benchmarked and KPIs can be identified. You can identify key personnel through direct association to turnover. Who creates it? They can be plotted on graphs indicating timelines. Graphic representation format is easy to follow and understand. It is component-based, all components of the business valued at current market value. This method is easier, faster, safer, more reliable, and it is simply the inverse of current methodologies. It is provable, and this method can be used at any time without needing to wait for the preparation of financial statements to apply internal and micro adjustments. Business valuations must be based on all components inspected and valued to provide proof. Tangible assets must be listed in detail and recorded in a traceable format for most applications. Stock or inventory must be valued to identify issues such as indent levels, obsolete, damaged, out of date stock. If comparison detail based on real sales is not in your report, then you mislead the instructing parties. It must be shown in full detail to allow others to overview your judgment or opinion. You must be able to detail your findings and show cause for your judgment. If the market views your opinion differently, they can form their own judgment on the facts provided. If this is not in your report, then your report is worthless. Investors should never act or rely on a report that is based on EBITs or EBITDAs. In fact, if you've suffered loss in the past, I would consider legal action. The world is changing rapidly, and if you do not know how to value goodwill and IP assets, you should learn. In fact, service-based businesses create mainly turnover and have virtually no tangible assets. It is this class of business structure that all invested industries, financial, banking, taxation, accounting and legal, need accurate, reliable information to settle legal disputes, partnerships and family matters. My methodology is market-based and capable of translation into balance sheets that satisfies the asset recognition criteria of the Australian Accounting Standards Board. That would assist accounting and financial markets greatly. The definition of an asset, according to the accounting industry, is, and I quote, "It must be definable and capable of reliable measurement and of course have future economic benefits." Now, there is a way to put you within the valuation ballpark within minutes. But unless you understand and comprehend this methodology and the insights that can be obtained by viewing the power and the strength and the support that is inherent in cash flows, you will never be able to assess business values accurately. And there is a way to know how much your future cash flows will be worth before you create them. This would be highly beneficial to most and could prevent you from going down the wrong road in the first place. This secret can be found in my book. I hope this presentation has highlighted the differences between the old and the new approach, and the subject matter is all outlined in my book, and I hope you get your copy soon. It will assist you to make better decisions. Thank you for watching.